Today, we're going to start the session with a conversation with Alok Nandan, General Partner at Emergent Ventures and also founding partner of Arca Venture Labs. Alok, welcome to the show. It's great to see you.
Likewise. Thank you, Shamana. Thanks for having me on the show.
You have this halo around your head. Feels like you're emerging out of the mist with, you don't need to change anything. I'm just teasing you.
Okay. No, I blurred my background because I'm sitting in a.
Looks great, actually. Looks kind of surreal. All right. So let's start by introducing you to our audience. So tell us a bit about your background as well as about Emergent Ventures.
Sure, absolutely. My name is Alok Nandan. Yeah, I joined Emergent as a general partner in 2017. My prior background is I've spent about 15 years as a product guy in enterprise software companies, both big and small. I started my career in Microsoft up in Seattle. I was there for about 7 years. I was one of the founding product managers of Windows Azure. Satya at the time was our VP, so presented to Satya a few times as well. I moved to Silicon Valley about 8 years ago. I was lucky to be part of a couple of startups here. One was a company called Umi Networks. I joined them when they were about 50 people, and in a couple of years, they went to 500 full-time people, and they IPO'd on the New York Stock Exchange in 2013. So I was lucky to be part of that IPO. After that, I was part of another startup here in Menlo Park called Tempo AI. This was incubated in SRI, Stanford Research Institute, where Siri came out. And what we were doing was building a Siri for the enterprise. And in fact, the inventor of Siri, Norman Winarski, he was on the board of this startup as well. So we were a small startup, about 10 people. After about 2.5 years, we got some traction in the sales vertical. A lot of salespeople would use it, and after about 2.5 years, Salesforce acquired us. So I was in Salesforce for a year as a director of product, integrated, relaunched the product, and then around that time started helping early-stage startups with product market fit and go-to-market strategy and so on. And that's how I ended up in venture capital. And delighted to be here. And Emergent is an early-stage fund. We do enterprise software investments only, and we are based in Silicon Valley. Our typical check sizes is, up to $1 million. So think of us as the first institutional check into a company. And we are very hands-on. Given my background, I roll up my sleeves and work with the entrepreneurs to get them to their first 3 to 5 customers. So that's in a nutshell about myself and the fund. Yeah.
Let's double-click down a little bit on Emergent and the specifics of the fund. How big is the fund?
Yeah, so Fund 1 was started in 2016. It's a $25 million fund. We will do about 12 to 15 investments out of this fund, about $1.5 million per company. So about $1 million in the first round, in the seed round, and about similar in follow-on in Series A. And our model is to lead the seed round. That's what we have done for about 10 companies already. Yeah.
Okay. Now, how do you define seed in your worldview? Because, I'm sure you're watching this trend out there. The seed has fragmented, right? It's now pre-seed, seed, post-seed, friends and family, pre-seed, seed, post-seed, pre-series A, small Series A, large Series A. So
correct.
Where in that continuum have you positioned yourselves?
Yeah, that's a great question. So, the way we look at it, you're absolutely right. There's a lot of noise around what exactly is seed, and there has been different sort of definitions thrown around. Our viewpoint is, if you think about the entrepreneur's journey, right, typically the first round tends to be their own capital or some friends and family, and then there is a large gap to get to a Series A, where the bigger funds come in with an $8 to $10 million round, right? So we operate in this large spectrum where they have raised some capital from friends and family. They are maybe building a product. and now they want to get to 3 to 5 customers so they can be actually ready for a Series A, right? So that is the space we play in. Now, some people in the Valley may call it pre-seed. $1 million check in the Valley today is probably pre-seed. We also do some cross-border stuff where startups are coming out of India. For them, $1 million is still considered a seed, right? So it depends on who you're talking to in the entrepreneur side as well. In the Valley, probably I think it's a mix of and again it depends on the whether it's a B2C consumer startup or an enterprise startup. But in the enterprise space, I would say a $3 million seed round is still pretty common, with we leading sort of $1 million, $1.5 million, and then maybe another fund co-leading with us, or the founder filling out the round with smaller angel checks. Does that make sense?
So let me probe that for a moment. You said companies that have launched a product and are getting ready to get their product in the hands of 3 to 5 customers. Did I hear that right?
Correct. Yeah. Ideally, they should have at least some MVP, some semblance of a product, and that's when we sort of engage. I mean, having said that, there are always exceptions.
Not necessarily a customer. You are okay with three customers.
Not necessarily. Yeah, not necessarily with a customer. They should have some MVP product that they can show. That is where we sort of that's sort of our sweet spot. Having said that, there are exceptions. There may be founders which are repeat entrepreneurs. For them, even if it's a PowerPoint deck, if it's a very compelling idea and the entrepreneur and the team is sort of seasoned at what they're doing, then we may come in at that stage as well. But typically it is when they have a semblance of a product, they may or may not have customers, and we engage with them and help them get to first 3 to 5 customers.
So, our community is going to be largely first-time entrepreneurs. And very often what we hear from investors is that they don't want to invest in first-time entrepreneurs until they have some customer validation. That's just a comment, that's just an observation about what's happening in the industry. Repeat entrepreneurs is a very different story.
Yep.
So you said enterprise software is your primary focus. Elaborate.
Correct.
What trends are you seeing? What trends interest you? Of course, I'm sure you're going to say AI, but get more granular.
Yeah, absolutely. Yeah, so there are 2 specific areas within that that we look for, and we broadly define the area that we look for is what we call intelligent software, which is software that becomes better with use. And it's another. We think it's a more simpler way of describing a software that is enabled by AI, right? It's basically becoming better with use. Yeah, and then in terms of specific subsegments within that, we look at cloud infrastructure. So technologies and infrastructure that's powering these applications, these intelligent software applications. That's an area of interest for us, and we have done investments in that. And then within the intelligent software space, we look for specific use cases which have sort of a business focus. So, for example, AI for a specific sales use case, like sales forecasting for AI, or it could be something in the marketing space, or it could be in the customer support space. So, apply what we call applied AI, or for a specific business use case. That's of interest to us, and we have done investments in all of these areas. For example, there's a company called BoostUp.ai, which is in sales forecasting AI. That is one of our investments. There's a company called SupportLogic.io. That's a AI for technical customer support. That's one of our portfolio companies. Yeah.
Now, you said geography-wise, you are doing cross-border with India. And does that mean that you're doing all over the United States and cross-border with India? Is that accurate geography?
Yes. So I'll double-click on that a little bit. So what we are looking for is entrepreneurs which have the ability to build teams outside the Bay Area. Bay Area, as you know, today has become super expensive, especially for hiring engineers, right? And with the check size, with the check sizes we come in, it's very, very difficult to build a product, right? With the engineers here, right? So what we are looking for is entrepreneurs that can build a team outside the Bay Area. And we have invested in companies which have a team in Atlanta, which have a team in Austin, or could have a team in Seattle or even Salt Lake City, right? So that's fair game, right? So anywhere where there is talent, as long as one of the founders is in the Bay Area, that's fair game. Now, India is interesting. There's a lot of enterprise SaaS companies coming out of India. Now, we find them here. And usually what happens is the founder is in Silicon Valley and we meet them here, right? So we typically invest when they are already here. And then maybe that part of their team, engineering team, could be in Bangalore or something like that, right? So that sort of is the model that is ideal for the companies that we invest in.
Okay. Now, talk a bit about trends. If you look at the last 18 months of your deal flow, what are you spotting by way of trends? Synthesize for me what's out there that's worth talking about.
So I think one of the big trends is around obviously AI is infusing every aspect of a business process. I think the next trend, and we haven't made an investment in it yet, but is around the explainability or the accountability of AI, which is around, how do you make sure that your machine learning models are actually explainable to a human being as a, in what they're doing, right? They're not like a black box, right? So that is an important trend, I think, which will apply to most of our portfolio companies as well as other companies out there which are using any sort of machine learning or AI, right? Which is around this explainability and accountability of these AI models. And McKinsey has a report also
I have
on
a question about this before we go on to the next point that you were going to make. I've been thinking about explainability. So your learning models start evolving, right? You have a learning model buried into any workflow function, whether it's sales, marketing, sales forecasting, whatever. And then the learning model starts to kick in gear and it starts making decisions, starts getting smart. To what extent do you see the engineers and the architects of these systems simulating where is this learning model going to go?
Maybe I'm not fully understanding your question. So when you say where will the machine learning model go in the sense that how will it evolve?
Yes, because as an architect of an AI system, you set up the heuristics on what's going to happen, how your machine learning model is going to evolve. But the data comes in and the machine learning model starts evolving. To what extent can you control that evolution is the question that I'm asking. And, it kind of relates with your explainability question.
Absolutely. Yeah. So, I think what companies will have to do is build guardrails around these models where if the model starts to produce results that are beyond a certain expected sort of spectrum of results, then I think it needs to be flagged automatically, right? You can write software to automatically flag it, right? That, hey, this model is quote unquote behaving badly, right? Or not as expected, right? So I think that is doable, and I think that will happen. And I'm pretty sure that's already happening. For example, in Salesforce has an Einstein group. And they have some of these checks and balances. At least they were talking about it a year ago, right? So, which is around having these guardrails built in so that a novice user or even a sort of a semi-expert user doesn't shoot themselves in the foot with the AI model, right? So these guardrails are being built, and I think there will be more and more. And the more sensitive the area, for example, if it is in HR, the model is deciding whether to hire somebody or not, and the data is somehow biased in one manner or another, then how do you control that, right? How do you have checks and balance, right? So there will be more and more work. I think it's also, I believe, a research topic, and so there'll be more research on this, as well as there'll be more product innovation around building these guardrails so that they're automatically caught when the models go out of bound, let's say, or out of the expected spectrum of results.
One of my concerns is that the first wave of AI models don't have guardrails, and they're going to come up with a lot of, questionable. I mean, sales is probably not the most risky territory, but HR, as you pointed out, is a more risky territory. And then if you move on to stuff like medical, healthcare data and stuff like that, that gets into very risky territory.
Yeah, I mean, I think you can't, with healthcare, I think there has to be a human in the loop, right? I mean, it cannot be that the machine is producing a result and there isn't a human reviewing that result before an action is taken. Right. So I think for healthcare, even for financial services, right? Like I'll give an example, right? Yeah. Let's say there's a model that decides whether somebody is creditworthy or not, and based on that gives out a loan or not, right? Now there could be some bias built into the model, right? That and so there has to be and that's where this explainability comes in, and that's where sort of a human in the loop has to be in the decision making path. Today to provide that checks and balance, right? And I agree that there is a lot of hype. Sorry, go ahead. Yeah.
Fintech is a segment where there isn't a lot of human in the loop, because one of the great benefits that AI is delivering within the fintech, especially lending space, if you look at small business lending and credit in general, all this fintech credit companies, they're claim big value proposition is that we approve loans within 30 seconds or 30 minutes or whatever, and there is no human in the loop. That's the whole reason the tray is to to do it quickly.
I think they're fine. I think you're absolutely right. But I mean, AI. I mean, you can still run it. I mean, human in the loop. See, if it falls within a certain range, then I guess, it will automatically get approved, right? And humans may only get pulled in if there is exceptions to the rule, right? So you can still do some of that fast processing with a human in the loop, because human is not reviewing every outcome that the model is doing. It's only reviewing the exceptions, right?
Yes. That's right.
Or the ones that are outside of the kind of the expected spectrum of results, let's say. Yeah. But you're actually absolutely right. I think this is, and I believe financial services are waking up to this. I think there's more and more accountability of the models being built in as we speak. And the fintech companies are definitely at the forefront of this in terms of adoption of these newer techniques. Yeah.
So switching gears a bit, which of your portfolio companies are you most excited about, and take us through an analysis of how did you encounter this company? What did you see that triggered your interest in investing in the company? And what I'm trying to do here is provide a couple of examples so that our audience can understand how you analyze deals.
Sure. So one of our portfolio companies is a company called Observe.ai, and they are in voice analytics for call centers. So I'll give you first the use case and then talk about the journey and how they're doing right now. So typically, whenever, we in the US at least, whenever we call a customer support, let's say you're calling Comcast because your internet is down, right? There is a voice that says that your voice may be recorded for quality assurance purposes, right?
Yeah.
But what they do is most of these voice recordings are just sitting there, and once in a while, 1 in 100 calls, there will be a QA rep who will listen to the call, manually fill out a paper-based assessment, as to how the call went. Was the customer happy or not? Was the problem solved or not? Right? So that's what happens today. So what Observe.ai came in and said, let's analyze every such voice recording, and they automatically, using machine learning and AI, and they automatically come up with a customer satisfaction score, an NPS score, and they come up with sentiment analysis of whether the customer was happy or not, and at the end of the call versus the beginning of the call, and they do this deep analysis of the calls, and essentially, now the company can get better call coverage, higher potential accuracy, and all at a lower price, right? And so that's what Observe.ai does. We are very bullish on them. We led the seed round. They raised the Series A from a well-known Valley VC. And they're executing quite well. They have two of the largest call centers in the world as their customers. They have companies like TripAdvisor and Square as their customers as well. And so that's on the company side. The way we found them is the founders are two engineers. One guy used to be a software engineer in Twitter here in San Francisco. The other guy was a software engineer in 1Mby in Bangalore, and they're both classmates from IIT. And when they were just ideating when they met us, and they had different ideas of what they wanted to do. But we met them and we liked the team, and so we kind of rolled up our sleeves and looked at different areas where we could build a product, and we encountered this particular area which was I felt ripe for disruption. So that's how we met them. The founder who was in Twitter, he had moved back to Bangalore because Twitter had acquired a company there called Just Dial, and he was leading the engineering there. And then after that, he left Twitter and started a company with his classmate from 1Mby. And we helped them find their third co-founder, which was a sales guy who had worked in this industry, in the call center industry. And he was super bullish about this particular space, and so he joined them, full time. And we helped the two founders interview this sales guy and sort of vetted him before he joined. And so, kind of the team got together, and we kind of helped them get to the first, product market fit. And even now, they're doing quite well. We are actively helping them find more people to join, and even bringing them potential customers. Yeah.
And when they started this company and when you wrote your first check, they did not yet have a product, or did they have the product already?
No, so they were actually building something else when they met us, and over the course of the next 6 months, they iterated and pivoted and eventually arrived at this idea. And initially, we wrote them a small check, and then we doubled down over the course of the year, and eventually led the seed round, right? So it was I would say, an extended dating period, but at the same time, we were actively helping them, kind of ideate and figure out what are the opportunities and so on.
So you invested in the team, really?
Yes, exactly. Yeah, that's the key, right? The stage at which we come in. The team is super important, and we need to see that is one of the key criteria we look for, and we look for people who are on this high trajectory of personal growth, and whether in terms of what they have done in the past, in terms of how they interact with people, in terms of their sort of balance, in difficult circumstances. So we observe that, and it's difficult to do it in one meeting, so we do it over a course of 2-3 meetings, and we do reference checks and so on, and we try to form a view of the person, because that is super critical at the stage we come in. It's more about the person than it is about the product or the market.
How many deals have you done that have this characteristic of investing in a team that doesn't yet have the positioning for their product or business figured out?
I would say about 1 in 4, so about 25% are like this.
25%, okay, good. That's pretty concrete. Now,
yep.
Can you talk about another example where the team was in place, but also they had more more idea about what they were building and where the product positioning at least was further along, and then you can tell me what were the rest of the circumstances. I'm just trying to get a different viewpoint.
Yeah, sure. This is another company of ours that's close to my heart. It's a company called Blitz.io with a double Z. And the founder, he's a pretty senior guy. He used to work in Oracle here in the Bay Area. And then after, so he's been in this database space for about 12 plus years. So he's a domain expert. He was in the core, database engine in Oracle, and then he joined a startup in San Francisco called MemSQL. He was a director of engineering there, the product and the idea was that when he was in MemSQL is a cloud database, a cloud native database, right? And so then MemSQL used to go into accounts and they would say, hey, buy a product. They had to show a proof of concept, right? And the proof of concept was, can you run this application that is already running an Oracle on MemSQL database, right? And even to do that migration and to show that proof of concept was very hard for MemSQL. It would take them 6 months, 12 months to do this. So this guy had an idea, and he left MemSQL and started a company. And the idea was, how can we make this migration and replication of data from a traditional Oracle or a SAP database to this new age cloud native database like MemSQL? So he built a product for that specific use case, and then he came to us, right? And so it was a very well formed idea. This guy was a domain expert, and he knew what he was doing, and he pitched to us, and that's how we funded him, right? So it was a completely different case where the product and the market was sort of well defined, and the team. The team is obviously important, and this guy has the domain expert. He's one of the. He's published papers. He's a well regarded person in this industry, in the database industry, distributed database industry. So that's another example. Yeah.
That's great. What you're highlighting is the tremendous desirability on investors' part of domain experts. This is something that we discuss a lot in the program.
Absolutely, that's exactly right. I think obviously there's an advantage to be an outsider into an industry, but as a startup to be able to crack product as well as market while being an outsider alone is difficult. So if not all the founders, at least one of the founders needs to be from that industry, right? And they need not be a super domain expert, but somewhat of a expert in that industry so that they know how to navigate into the market or the industry that they're selling into. Yeah.
But honestly, I hear from lots of investors that they're very ready to find, if they do find a real domain expert, the fundability goes up tremendously.
Absolutely. No doubt about that. Yep.
All right. Well, Alok, that was a fascinating conversation. Thank you for all your input, and I will let you go home.
Okay. Thank you, Shamina. Thanks for having me. It was a pleasure.
Great seeing you.
And,
great seeing you.
Yeah. Yep.
Bye-bye.
Cheers.